Welcome back to Equity Mates Investing, a podcast where we explore what's possible in the world of investing. If you've just joined us for the first time, a massive welcome, because in today's episode, Ren is solving the housing crisis. We've got a Pimp My Portfolio, and we're closing out with this month's book club. So cannot wait. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. We should be clear that Ren solves the housing crisis is like the It's Always Sunny in Philadelphia opening. Like I'm not actually solving the housing crisis.
Yes, that would be amazing.
It would be amazing. It would be surprising.
It would be. Well, let's crack into it.
Let's do it. So the reason that we want to talk about housing is because it is front of mind for everyone. But I think it's shaping up to be the biggest election issue. So the next federal election will be on or before the 27th of September next year. So we're hurtling towards an election. Labor focused on supply. They are doing the $10 billion Housing Australia Future Fund to build more homes. They've got that target of 1.2 million new homes over the next 5 years from the 1st of July 2024 to 2029. We haven't even entered the measurement period yet, and everyone is pretty confident we're going to miss it. The Liberal Party's budget reply, they made housing pretty central. They're really so if Labor is focused on supply, build more houses, the Liberals are focused on demand, reduce the amount of people trying to buy. Permanently reduce migration numbers was the big tentpole from Dutton, from 185k permanent migrants each year to 140k for the next 2 years. Senator Andrew Bragg also wants to allow first home buyers to drain their super, which actually would increase demand.
Yeah, that's not a demand.
Yeah. Anyway, that's a separate policy. So all of this talk of supply and demand and housing got me thinking about the empty housing data. Do you remember that from the census?
Not really, no.
So 2021 census revealed that 10.1% of Australian homes were unoccupied. So that was 1.043 million homes were unoccupied on the night of the
Including
census.
units?
Yeah. Just housing
Everything.
dwellings. Yeah. Which is pretty crazy when you think about it. We're trying to build 1.2 million homes over the next 5 years, and on census night there were 1 million homes unoccupied. And so I was thinking about that, and then I also saw this article about ghost homes. So the ABS released a report, and then the Daily Telegraph jumped on it and created the label ghost homes. 43,000 in New South Wales, 22,000 in Sydney alone, just unoccupied homes, not because of, second homes for holiday houses or people were traveling or anything like that, but actually abandoned homes. And so all this abandoned home stuff got me thinking about the census data, and I actually wanted to just dig into this number and understand it a little bit better. Is there actually something here, or is it just something that doesn't actually offer a way
Alternative,
forward?
Yeah.
So, first of all, 10.1% of homes in Australia were unoccupied on census night. That number isn't actually out of the ordinary. Here is it going back to the start of the 1980s from the census. So 10.1% in the 81 census, 10.3% in 86, 10.3% in 91, 9.4%, 9.2%, 10.4%, 10.7%, and then 11.2% in 2016.
Pretty consistent.
So it seems super consistent that Australia has just a heap of empty homes. And so for me, the two questions that come out of that are, how many of these primary residences either owned or rented out that were just not occupied on that day for whatever reason? People were traveling or something. So are they actually homes that could help alleviate the housing crisis? And then secondly, where are they located? Because empty houses in beach towns aren't as helpful as empty houses in capital cities.
Yeah.
So to answer the second question first, it's not just holiday homes in regional areas. Taking from the 2021 census data, Sydney, 8.3% of homes were unoccupied on census night. Melbourne, 10%. Brisbane, 6.8%. Adelaide, 7%. Perth, 8.5%. Hobart, 7.3%. Darwin, 9.6%. Canberra, 6.6%. To start with, there's a lot of empty homes in capital cities. At least there were on census night. But unfortunately, a lot of housing experts say this isn't actually a stock of homes
Yeah.
that we can draw on. So they look at some of the numbers and they say the majority of it is people just not being at home on census nights, like more than 40% is just people traveling or not there. So then the remainders is like there's a percentage of houses that are for sale, there's a percentage of houses that are in disrepair, and some other things. I think there is like a percentage of vacant homes that could be freed up for housing stock, but it's not nearly 10%.
Yeah.
Now, towards the end of this segment, I have 3 policy recommendations.
Okay.
And one relates to whatever that percentage of housing stock is. But my initial excitement about that 10%, where it could be, it very quickly fizzled.
Yeah.
I think there are some policy decisions that could be made so then I was like, how do we compare internationally? Like, is this just uniform throughout the world? In the US, vacant homes in 2022, 10.5%.
Okay.
The UK, 6.1%. In England, 8.2% in Wales. France, 8.2%. New Zealand, 5%. Germany, 2.5%.
Oh, wow.
So I think there's probably some policy tweaks that you could make to get to Germany levels. But really, from everything I could read, there's not like 500,000 homes that we could unlock.
Yeah.
But when I was reading it, there was something that could be unlocked.
Okay.
Another potential solution to the housing crisis. We shouldn't be looking at abandoned homes. We should be looking at abandoned rooms. How crazy is this? For data from the ABS, Australia has 13 million empty rooms.
As in like a 3-bedded house, only 2 beds used.
2 being used. The ABS survey on income and housing revealed that nearly 76.8% of households, totaling around 7.4 million houses and apartments, have surplus bedrooms.
Yeah.
Now, look, I'm going to say that 1 surplus bedroom seems reasonable. You might want guests to stay. You might have a carer that needs to stay, but obviously if the carer is staying there then it's not a surplus bedroom.
Yeah.
You might have kids returning home, and you coming and going and you want an extra bedroom for them. Plenty of reasons. But 2 spare bedrooms, 3 spare bedrooms, more? Now I'm starting to question you. Here are the numbers. So 32.5% of households in Australia, this is houses and apartments, have 1 bedroom spare. 31.8 have 2 spare bedrooms. That's more than 3 million homes. 12.5% have 3 or more spare bedrooms. That's 12.5% of all homes in Australia.
Yeah,
That's
so much of this is legacy, though.
That's 1.2 million homes.
Yes.
They're just hoarding bedrooms.
That was the Australian dream. Still is.
Well, the Australian dream for most people now is affordable housing.
I think you'll find if you cut those numbers to houses built in last X years versus, X decades, you would find it might be a bit different. At least houses are a lot smaller.
You're saying we're building smaller homes.
Yeah. I think.
But look, that could be true. But 13 million bedrooms not being used, even if you could halve that, and you could free up 7 million bedrooms.
Yeah, but it doesn't match with the one above. Like, you'd either have to force people to sell or live with each other.
You could try and use policy to incentivize both of those things, which I'll get to in my policy prescriptions. Now, the Australian Housing and Urban Research Institute research suggests that the majority of spare bedrooms reside with older homeowners. Mm-hmm. Not surprising. The age brackets 55 to 64 and 64 to 74. And not surprising because they probably have had families, those families have moved on, and they've kept the house. But we do make policy choices around incentivizing people to keep large family homes and then not rent out bedrooms in large family homes. And this is mainly to do with the pension assets test. So the primary resident doesn't count. The primary residence doesn't count for your asset test for your age pension. So there's an incentive to put as much of your wealth as possible in the primary residence, because then that is excluded from the calculation. But also, If you have a spare bedroom, you pay income tax on the rent received from leasing those rooms or Airbnb-ing those rooms. And so for pensioners, if they were to lease or rent out short-term those rooms, that would then be income that reduces their access to the pension, reduces it they get. So we make policy choices around that incentivize people to have a massive primary residence and then not create housing with their spare rooms.
Yeah.
So, as much as it is the way it is the way it is because we made it the way it is. And we continue to choose for it to be that way. So as I said, 3 recommendations, not a solve for the housing crisis, but tweaks we can make. First recommendation, let's start collecting data on why these dwellings are unoccupied on census night. So 10.1% of dwellings were unoccupied. We used to collect data on why that was the case. The last census we collected that data was 1986. So first policy prescription is pretty simple. It might be hard to get that data, but let's start collecting why. In 1986, a quarter of vacant homes were holiday homes and 35% simply had the resident absent on census night. But let's find out what is going on. How many houses are abandoned? How many are just being sat on for the capital gains? Let's actually understand what's going on. Second policy recommendation, use tax policy. Let's have a prohibitively high tax on truly underutilized homes. Like if it's not, you're preparing it for sale, you're fixing it up, it's a holiday home that you live in part of the year. Like if it is just an empty home that you're land banking, let's tax the shit out of that.
Yeah.
I would also say, and this is going to be controversial, right now we allow negative gearing for policy reasons, which is cheaper rent. If we didn't allow negative gearing, the first thing that would happen is landlords would increase their rent so all houses were positively geared. So that's a policy decision we made. I would say you could quarantine it to those policy reasons and maybe don't allow negative gearing on Airbnbs. Prioritize long-term secure housing. Just something to think about.
Tough to regulate that.
I mean, every regulation's tough to regulate.
Yeah.
But you'd be pretty easy to see, like, the occupancy rate. Oh, I mean, actually, it's not tough to regulate. Do you have a lease lodged with the state regulators?
True, yeah.
Yeah. Just something to think about. But, what we want to do is increase long-term secure housing, not short-term rentals here. And that would just incentivize landlords to go long-term leases over short-term rentals. Third policy recommendation, encourage pensioners to use their spare rooms or to move. People don't like the aged divide, but you could really incentivize pensioners if you offered 100% tax-free rental income on spare rooms, encouraging them to contribute those to the housing market without the financial burden of having their age pension reduced.
I mean, yeah, you can understand why it's reduced though, because they're getting more income. So like it nets out.
Yeah, but like what we want is to increase housing here.
The main thing you're going to have to convince is like your grandma to take on a 21-year-old who's at university and wants to party all night.
Well, to be honest, I think what we really need to do, and the government have already started making moves. In 2022, they passed a law around encouraging people to sell their homes. So if people on the age pension sell their primary residence, there's like a deeming rate. So your assets, it's deemed to get a certain return. And the money that you make from your sale of your house, rather than being deemed at 2.25%, at the time it was deemed at 0.25%, which is, I guess, trying to incentivize people to downsize. But for me, like that's the opportunity. It's like, what else can you do to downsize? That's sort of the carrot that they've passed. But like, is there potentially a stick where it's like, if you are sitting on empty rooms, perhaps it does somehow, there's some deeming rate that it does contribute to your assets test. Like there's an income deemed from those spare rooms that you're sitting on, and then that does reduce your income. So all of a sudden there is an incentive to downsize. Like for me, it's like there's this stock of housing that isn't being utilized. We're in a housing crisis. What are the things that we can do creatively that doesn't rely on let's build more homes in the next 5 years when we know we're not going to reach that target?
The question for that are those the homes that are needed the most? the 4-beddy that the grandma
Yeah,
has?
that's a good question.
Or is it the 2-beddy that
But to be honest, like
they would downsize into and have the money to afford before, you know, Ren and Alice go and bid on it, for example?
Yeah, it's a good question. But think about how tough it is for young people to get rentals these days. And like the family home, yeah, like location-wise, it might be an issue. But we lived in a 4-bedroom home when we were renting.
Yeah,
You know,
early
like as
days.
students.
Yeah, absolutely. Yeah.
Yeah.
But that's still owned by...
It's not about ownership. For me, it's rent or buy.
Yeah, right.
Yeah. Like if you could massively increase the stock of rentals, I think that's a win.
Yeah.
Because
definitely.
then like the pricing pressure will be off
Definitely.
rentals.
Yeah, absolutely.
Yeah.
Nice.
So I didn't solve the housing crisis, but there was a bunch of data that I did a deep dive on and I wanted to talk about.
I mean, I understand the point about negative gearing, but if you got rid of it completely, grandfathered it so it didn't impact, but from here, like, it would have a significant effect, I reckon.
I'm actually skeptical that it would.
Because I think a lot of people, like, I think you'd just get a...
I think it would be fair. Don't get me wrong, it would be fairer, but in terms of solving the crisis, like, what's the mechanism that it would actually...
Well, you'd probably just, I don't know, at certain levels of the market, just take out pure investors. Like, think about those people who have multi-property portfolios. It's all off.
But the thing is, investors
gearing.
would still buy the properties, but they just couldn't negatively gear it. So they would positively gear it. So rents would go up. But they would still expect capital growth. Like, investors are buying it because housing has been such a good investment asset. Changing negative gearing doesn't actually change that.
I reckon there would be a dynamic between, like, you just couldn't charge the rents that...
Yeah, well, then that's the
like
question.
You couldn't positively gear it. You'd be looking at trying to charge 10 grand a week in rent.
Oh, yeah, I know what you're saying. The problem is with the rental market so tight, but you know what I mean.
Yeah.
I think one part of Australian economic history that's often forgotten is we did remove negative gearing. We removed it for like a year in the 80s, and then the government put it back on.
There you go. Impossible.
My theory is that if we removed it today, rents would go up before house prices go down, just a sequencing thing, and that would hurt.
Yeah, definitely. Absolutely.
So don't get me wrong, I'm not a fan of it. And I think from a tax fairness point of view, there's a really strong argument to remove it. But I think in solving the housing crisis, I don't think it's to solve the short-term solve we hope it would be.
Yeah.
Whereas those spare bedrooms, get them on the market.
Yeah, I don't know if I see it, but some really interesting numbers there. I didn't realize the extent of which there are open homes or empty homes sitting there. I think when you do compare globally, it's it's not just our problem, but yeah, empty bedrooms. I just couldn't convince my grandma. I know. It's not, but I get it. There's opportunity there. Yeah, yeah. Well, you should have put in commercial property in here. How many empty office spaces are sitting in
There's a
CBD.
There's an office building in Melbourne that they converted to residential.
Perfect.
I think it's a good call.
Yeah. Perfect.
Yeah.
Anyway, if you have some comments on rents,
hit me up. I'm actually going away for 3 weeks, so that's why we did this episode now. So hit price up.
But come and join us in the Facebook discussion group. We'll be obviously chatting all things housing plus all things investing. So you'll find us on Facebook. It's the Equity Mates podcast discussion group. But we'll leave it there. Let's jump into Pimp My Portfolio. All right, it is time for
This is Pimp My Portfolio. Pimp My Portfolio.
That's it. Pimp My Portfolio, where you have the opportunity to submit your portfolio to get our expert, Luke Laretive, to give his thoughts on how it could be improved. Luke, welcome back to the studio.
Expert's very loose.
Well,
loose use of the word.
That's not the introduction we're looking for.
You're more of an expert than us, that's for sure.
Now, this is a first for Pimp My Portfolio. We've had our first official no-show, but Shane, who we couldn't get on the phone, has still submitted his portfolio.
He's a busy man, Shane. Hard to get hold of. Very hard to get hold of. Time is money.
He has a lovely voicemail message, as we've heard a few times.
He was very excited to come on.
Yeah, well, sorry, Shane. Luke's a busy man. You got to take your shot when you can. But we do have Shane's...
Lunch is for wimps, Shane. Lunch is for wimps.
But we do have Shane's portfolio. So we thought, Shane, when you listen back to this, we thought we could still go over your portfolio and unpack what you've been doing and how Luke thinks about it and some of the general lessons that you can take from it and then we can all take from it. So as always with these segments, we're going to start with a bit of an overview of your portfolio. So Bryce, what are we looking at?
So Shane's portfolio is a mix of ETFs and individual stocks. There's about 25 or almost 30% of the portfolio is in two leveraged ETFs, Gear and GJUS. And then the next biggest holding is Pilbara.
Pilbara. Come on, bro.
Pilbara. I now just do it because it's a thing.
It's
anyway.
a thing,
So what stands out to me before we get to the individual stocks is that there are a number of thematic ETFs as well. So you mentioned the two leverage ones, but then there's also a Bitcoin ETF, the Global X Bitcoin ETF. There's a silver exchange traded product.
Yep.
There's gold.
Yep.
India and also semi. Yeah, and uranium.
And VDHG.
So I guess, core portfolio VDHG and the two leveraged ETFs potentially. They're more index tracking. And then there's a number of thematics. And then you mentioned individual stocks. Pilbara, CSL, Linus is in there.
Minres, Elders.
A few miners. All right, that's probably a good enough overview.
Yep.
So with that in mind, Luke, what is the name for Shane's portfolio?
After the very, very hot, chilly, the California Reaper.
California Reaper.
Okay.
What's the context for that?
Look, just for the leverage and the spiciness of it. And look, actually, I like the leverage, right? To be honest, I think not enough people use leverage in investing. It works both ways, and I think the cash call potential of a margin loan and the stop out on some of the warranty derivative type product can be challenging for people. But if you've got the cojones for it and you've got the right kind of weightings and your portfolio is set up properly, it can be pretty effective for young people in the same way that the only reason you make money on a property is because it's geared 5 times. So probably more interesting than talking about the general market following stuff. Like we'll go nitty gritty. I'll ask you guys actually maybe as a point of interest, semi.
Yeah.
Every ETF, every equity mates person I speak to seems to hold this ETF.
Nice.
Is this just Nvidia fever or what's the go here?
Probably. There was there was TSMC fever before, but that wasn't as contagious. I'm really trying to torture this metaphor. But yeah, I think like the last couple of years it's been big focus.
But I think it makes sense, right? If you've got someone who doesn't want to have to pick between Nvidia, TSMC, ASML, like this is an ETF that like it has performed incredibly well for it's done its purpose.
Yeah, sure. I would just argue like if you're good enough to name those 3 stocks, well, you should be good enough to buy them yourself.
Fair, but there's also like a 10
value.
others in there that can't be named that have equally contributed. We were looking at an episode where it's the rising tide lifts all boats, and so this ETF is I can understand why a lot of our community are in it.
I think I'm not saying it's good or bad. I'm just trying to have an interesting conversation.
I think like the thesis is different. It's like when there's individual stocks that you're picking in a sector that you think is interesting, it's like you're willing to take on the idiosyncratic risk of like, this is a company that's going to execute, this is a company that has technology that's going to outperform, or in like the supply chain of semiconductors, like I'm going to say that Intel's foundries are going to be more popular in the next wave of 3 micron semiconductors than TSMC's foundries. Like you're making a bet on a company, whereas the thesis around the ETF is I am betting that this thematic is going to, as a whole, grow, and I'm not going to try and pick winners.
Yeah, and I think that's probably where these thematic ETFs get appeal. I suppose we did some work recently because I've seen so many of these things and recently in these portfolios for the first time, and they all sort of underperform eventually, right? It's better to own, longer run, it's all better to own the market. So unless you're going to be good enough to buy and sell these things, I think buying them in the first place can be a bit erroneous. And I'm glad that everyone's making money on the Momo trade at the moment, and I'm glad that I'm glad that these ETFs allow you to do that in a more diversified way than having to pick one or two, or be able to spend $1,000 and get exposure to a theme. So I don't begrudge people for buying them, and I think they're a good idea for certain things. I do just wonder though, it's not. These ETFs have proven over time they're not bottom draw.
Yeah,
and
you know what I mean? Like this needs to be actively managed, like you would pretty much manage a stock.
Yeah, and we talk about that. Like, these shouldn't make up bottom of the draw. Forget it for 40 years. Core portfolio ETFs.
But I mean, there's nothing in my view that is bottom draw. But if you wanted to play that bottom draw game, this isn't what you play it with.
You don't think a broad-based index fund is bottom draw?
I think that is.
Yeah.
But what I'm saying is that I don't buy broad.
Oh,
index
okay.
funds,
Yeah,
right?
yeah.
So
Nothing in your portfolio.
No. But I think that if you're if that's what you're doing, and it's perfectly reasonable and sound, as we've talked about a lot, I wouldn't be putting these sector-based ETFs in that bucket. They're in your satellite.
I reckon a lot of people think of thematic ETFs as core. I certainly used to. Like, I used to think like ETFs are all core, but now, yeah, I'm very much on the treat them as stocks.
If you want to, I mean, my view on these sort of thematics is to find, I prefer to find managers who can gain exposure to these things, but in a more measured way. And so whilst the concentration's great and it's worked out well for this particular example, there's lots of other things that haven't worked out so well in these sector-based ETFs. And I would just rather have an active manager who says, okay, yeah, I have been through every single stock in the semi-sector, and yeah, I'm going to own NVIDIA and ASML. I'm just pulling names out of my bum. But I'm going to also own them with Petrobras and BHP and Louis Vuitton, Moët Hennessy, and a bunch of other stocks in a diversified portfolio. I just feel like you want to be able to source alpha from a range of places, and that's really just spicy beta.
Yeah.
And that's kind of sort of what I don't like. I like, if you think about a equity market neutral manager, which maybe you guys haven't talked much about before, essentially that's me saying I'm going to short Rio to the same value that I'm going to buy BHP. And I'm going to bet that BHP on a market neutral basis is going to outperform Rio. So I like to think of things in that kind of context as well. And I reckon, the beta side of it's kind of a bit so.
I want to ask about another feature in the portfolio we mentioned earlier, the gold ETF and the silver ETF.
Mm-hmm.
First time we've seen a silver ETF. How do you think about these commodity plays in a portfolio? I
think gold has its place. It's got pretty low correlation to equity markets. It's a pretty decent diversifier. It's one of the better diversifiers out there. I don't know if that's an ETF that buys physical gold or it buys stocks.
It is.
Yeah, the physical gold stuff I like. So the gold stocks, particularly if it's an Australian-focused one, they are, in my view, more of a warrant or a leverage play on Western Australian labour costs, and not so much a play on the gold price. But yeah, the physical gold stuff I actually really like. I understand the sort of the macro arguments to it, but I think the idea is just not to get too complicated with it or try and be too clever about it. Just understand that historically, gold's, I think it's like 0.2 beta, so it's pretty low correlation. It's going to give you some diversification benefits, gives you a hedge against inflation, but at 2%. You got to start asking yourself, how much of a hedge am I actually getting here?
Yeah. So that's 2% of his portfolio.
Yeah, and the same with the silver thing. The silver's kind of a play on, the same sort of themes in a lot of ways. There's a lot of, I don't want to use the word conspiracy theory, but I'll use it, conspiracy theory type narrative around why silver's the best investment since sliced bread, and it kind of pops up every few years. I find there'll be one or two clients will ring me every sort of 2 or 3 years about they've read something on some deep dark blog somewhere, and someone's silver, it's going to be the we're going to need it, and blah blah blah. I think the only argument about silver that I do like is it's very much required for a lot of renewable energy, particularly solar. You need a lot of silver, so I don't really understand the supply-demand dynamics, so I wouldn't want to comment on whether that's a good investment or not. But certainly, from what I've read, there's a thesis there, and again, though, it's kind of one of those things that's probably not at 2%. It's not going to do probably what you want it to do for you.
Just to close out, one thing I've noticed in a lot of submissions of portfolios is the dynamic between VDHG and other ETFs in the portfolio. So VDHG is the Vanguard Diversified High Growth. It's pretty much like major developed markets around the world, 70% of which is the US. And Shane here also then has large weightings directly in both GJUS, which is leveraged US, and Gear, which is leveraged Aussie. I'd be questioning the role that VDHG is playing in the portfolio.
You just got more pretty much US
Overlap.
developed market equity exposure
Yeah.
with 20% Bloomberg global aggregate kind of bond exposure. So yeah, I would also argue that this portfolio doesn't make a lot of sense to me if I wanted to be critical. Weights are all kind of skew if some of these sort of satellite individual stock holdings. I'd be asking not necessarily the company per se, but questions about why they're there, or if they're going to be there, make it more sensible. But there's enough encouragement there to good start, not a complete 7 out of 10.
7 out of 10,
yeah.
nice. Shane,
7 out of 10. I'd
be
that.
taking
Yeah.
7 out of 10.
I like the gearing. It's it's unique. It's good. I
Yeah.
like the cojones.
If you
I'm
think
about
that's
it.
unique, wait until you see Bryce's portfolio.
The proverbial
This
show
is the
bag.
California Reaper. I can't get much hotter than that.
No,
is it?
no.
Anyway. Well, Shane, I hope you got something out of that. Unfortunately, we couldn't get you on the phone, but thank you for submitting your portfolio. If you're listening at home and would like to submit yours, head to equitymates.com/contact. If you would like to chat to Luke in your own time about your portfolio, investment strategies, and personal advice, then head to equitymates.com/advice, and we'll make sure that we connect you with Luke, and he'll actually be able to sit down with you and talk you through it. So Luke, thank you.
Pimp
as
my
always.
portfolio.
If you would like to submit to Pimp My Portfolio, head to equitymates.com/contact. All we need is a screenshot of your portfolio and your name and email address, and we will be in touch from there. Don't miss your opportunity to talk to Luke or Adam. We're going to take a quick break, and on the other side, we are back with this month's book club, where we're looking... This one, actually, Ren has been winding up for a while now, desperate to talk about it. So we're going to get stuck into it on the other side of the break. We'll be right back. Welcome back to Equity Mates. We've covered off Ren's solution to the housing crisis, or part of. We've had Pimp My Portfolio with Luke, and now we're closing out with this month's book club. So there's been a lot happening over the last month or so around Paramount Global, and we've withheld from talking about it because A, it hasn't quite panned out, but B, this month's book club is certainly centered around the story.
Yes.
So let's get stuck into it, Ren. Firstly, what was the book?
So the book was Unscripted, The Epic Battle for a Media Empire and the Redstone Family Legacy by James B. Stewart and Rachel Abrams. So all about Paramount Global. So what this book covers, it's the story of Sumner Redstone, who inherited his family's movie cinema chain, National Amusements.
Okay.
Made that a massive global success, but in the process also created Viacom CBS. Now, Viacom CBS owned Nickelodeon, the Comedy Channel, CBS, which is like a big network over in the US, MTV, and then also all of Paramount Global and Paramount's movie studios. So massive. He was like a big media player in the era of like the 80s, like Rupert Murdoch and John C. Malone and like all those big cable and media titans. Sumner Redstone was a big name in that space. And so this book doesn't cover that, but it covers Sumner as an old man and the fight for the billionaire's estate between his family, the leaders of his businesses, and his girlfriends. And yes, girlfriends plural. So Viacom CBS, which is now Paramount Global, owns a number of the big media properties that we're all familiar with today. But importantly for us, it's not their big media properties. It's one of their smaller media properties. They own Channel 10.
Yes.
The Australian free-to-air TV network.
God, what an asset.
I know. And it's newsworthy because Shari Redstone, so Sumner's daughter, is currently negotiating to sell Paramount Global to Skydance, which is a company owned by Larry Ellison's son. Larry Ellison, the 5th richest man in the world, co-founder of Oracle. His son is looking to buy Paramount Global and Channel 10 for a price which is far less than $26 billion, which was offered by private equity giant Apollo, which has people up in arms.
Yeah.
But Bryce, none of this is included in the book.
Okay, good.
My overall takeaway of this book, it is interesting, salacious, and I learned nothing about business.
Really?
Yeah.
It's just a story.
Dude, it was so
just a good story.
It made me really sad.
Oh, right.
Well, like not like crying sad, but kind of just like,
Where's the world coming to?
no, just like this sucks. Like,
Oh, right.
everyone in this book sucks.
Okay.
I hate every character involved. So the first half of the book is about Sumner falling out with his family.
Okay.
So Shari, and then he has a son as well, falling out with them, losing touch with them. He has a series of girlfriends who he's a pig.
Yeah.
Like he's just a piece. Series of girlfriends, showering them with like literally millions of dollars and Viacom stock and like all this stuff. But he's just like, yeah, like he would have got Me Too'd if he was.
Okay.
Yeah. But then it turns into this story of elder abuse where 2 of his live-in girlfriends basically isolate this 80 and 90-year-old man from the rest of his family, convince them that his family is all out to get him and don't love him, and then basically convince him to put them, the 2 girlfriends and their families, in his will, and basically they make a play to try and take over his media empire. But it's just depressing elder abuse. They just abuse this old man. It's sad.
Wow.
Anyway, so that's the first half of the book. In the end, one of the girlfriends has like a secret relationship on the side, and that comes out, and then she gets booted, then the other girlfriend gets booted, and Shari, the daughter, comes in and like wins the battle and takes back control. And that's the first half of the book. And I actually, at that point, I thought, is this book done? But no, it's not done, because it gets even worse. Because then the book is about Shari taking control of the media empire.
Right.
So at one stage, the company got split in 2. So there's Viacom, which is Paramount and a lot of the cable channels, MTV, Comedy Central, Nickelodeon, and then CBS, the TV network. And so Shari then has a battle with both of the boards, and both of the business leaders want to take control and want to remain in control of these companies. Shari wants to take control. A lot of maneuvering. Like, the one thing you learn about business is how important boards are relative to CEOs, and how much a board can be focused not on company fundamentals and like battles of personality like clicky. Anyway,
Schoolyard stuff.
But then, so Shari wins the battle for the Viacom board, and then it's about the battle for the CBS board, and that's like the last third of the book. Les Moonves he was one of the most powerful and influential men in Hollywood. He was like the 3rd highest paid person in Hollywood. He was an actor in his own right. Then he became the CEO of CBS, and his share price performance was amazing. Like, investors and the board all loved him because he had an incredible business track record. But then, in case you didn't hate all these characters enough, then the last third of this book is about Les Moonves getting Me Too.
Oh my god!
And like all of these sexual assault allegations coming out against him, and like just terrible story after terrible story, and how he tried to cover it up, and then how Shari was trying to figure it out, and how the like Ronan Farrow and the media were getting a whiff of it, and then the book ends with it all coming out about him and him being disgraced and leaving, and you're kind of left with this bitter taste in your mouth where Shari ends up controlling the empire. Sumner dies towards the end of the book, but he's kind of been an invalid for most of the book. And you're just like,
what happened?
All these people suck.
What a roller coaster. Damn. Well, it had good potential, and I think the story surrounding it is certainly interesting currently with what's going on.
I mean, look, it's a really
Paramount.
interesting story.
Yeah,
but don't read it if you want to learn about investing in media businesses.
business lessons. Well, we'll certainly keep you updated with what is going on and how things pan out for the Paramount Global Skydance offer. But what's next month?
Yeah. So
What's
next month, Jim Simons, who
Nice.
sadly died last month, the founder of Renaissance Capital,
Yep.
one of the best investors to ever do it. He really sparked this whole quantitative investing revolution. There's a book on his life. It's called The Man Who Solved the Market, How Jim Simons Launched the Quant Revolution. It's by Gregory Zuckerman, and that will be the book that we're reading for this month's book club. So jump in, read along, and we'll be back in a month to talk about it.
Love it. Well, I've heard this is a cracker, and time.
I mean,
time
feel
as
free to
well.
read
Yeah, I
along.
might actually.
Yeah.
I might actually read the Spark Notes. We'll see. But that brings us to the end of our episode today. If you would like to submit to Pimp My Portfolio, head to equitymates.com/contact. If you'd like to submit a book recommendation, same place as well, equitymates.com/contact. And make sure if you get a lot of value out of our show, then we would really appreciate it if you could leave us a 5-star rating and a review on the podcast app. It certainly goes a long way to helping us get in front of new equity mates to help them on their investing journey. But Ren, absolute pleasure to chat as always.
Yep.
You're off.
I am off.
You're off
yeah.
to Turkey for a few weeks, so
Yes.
we'll be
Not to get a hair transplant.
not to get a hair transplant. So over the coming weeks, we have heaps of content. We've got a series on superannuation with Vanguard. We've also then got 8 stocks that we're going to deep dive into as part of our winter series, thanks to Superhero, plus more Ask an Advisor, buy or sells, and expert interviews coming up. So plenty will continue as Ren heads over for his hair transplant in Turkey. Always good to chat. We'll pick it up next episode.
Sounds good.